Welcome back. You're listening to Houston Real Estate Radio. I'm your host, Shannon Register, and every week we bring you news and information you can use on your next real estate transaction. Today, we are going to talk about some tax tips for you, give you a little bit of information about how homeownership benefits you, your bottom line on your taxes. We're going to talk with Gary Cooper from Gary Cooper CPA firm down in the Heights and get his take on it. You know, we've got April 15th coming up soon, and I know some of you guys are working on your taxes, but before we get started, I want to give you the call-in number. So if you've got a real estate question or if you have a question for Gary, that number is 281-882-8088, and we'll be happy to answer your questions right here on the air every Sunday between 11 and noon. 281-882-8088. All right, and if you have not liked our Facebook page, jump over there and like us on Facebook. We put out the show every week on Facebook so that you can catch it online if you did not hear it live. All right, Gary, welcome to the show, Gary.
Thank you for having me, Shannon.
I know you've been on before. Gary Cooper has Gary Cooper CPA firm down in the Heights. He helps a lot of clients with a lot of different things having to do with your taxes. And I know tax season's coming up, and I know you're in a rush. You got a lot going on, so we'll make this short and quick. But I want you to tell the homeowners out there what advantages they have in being homeowners over renters. They made a great choice to buy instead of rent. What are their advantages?
Well, I'll look at cash flow, cash in, and cash out. If you're renting, you're probably paying the same amount of rent as you would pay if you were making a mortgage payment.
Mm-hmm.
Well, it can have a difference in your taxes because rent expense is not a deductible item. It's a personal expense. But mortgage payments is full of interest and taxes.
Mm-hmm.
And so with that being said, that is typically going to raise you above the standard deduction where you will be entitled to itemize your deduction. Well, also part of itemized deduction is the sales tax deduction for 2014, where there is a computation that's built into the software. However, if you purchase any items over $500 each, they are considered large items in the terms of IRS code. You can take extra sales tax on those particular purchases. Also, contributions. You make cash contributions.
Mm-hmm.
And another item that people really don't take advantage of is non-cash contributions.
Like donations to Goodwill, that kind of stuff?
Absolutely. And there's charts that the IRS will publish that will provide you thrift store value.
Mm-hmm.
And it's much greater than $50 a bag. Typically, if you use the charts, a bag of clothing will probably be more like $500. And so having the mortgage interest and having the property taxes, now you're going over the standard deduction, which for married filing jointly is $12,400 and single is $6,200.
Mm-hmm.
You'll go over that with your mortgage interest and your taxes. Then you got the sales tax, charities, investment interest, and if you are an employee that has employee business expenses, that's put on Schedule 2106,
mm-hmm.
that's use of automobile, office and house, travel, entertainment, and that expense will also be deductible as well. So having a home really starts qualifying you for the other itemized deductions that can make a difference in your tax liability.
Now, so if you're a renter, you are most likely not itemizing your taxes, and you wouldn't be able to take off those donations. Is that right? In addition to not being able to take off your mortgage tax and your interest?
Well, a simple way to look at this is there's an item called the standard deduction.
Mm-hmm.
And you take the standard deduction in lieu of itemized deductions.
Okay.
If you don't have adequate itemized deductions.
Mm-hmm.
And for a married couple filing jointly, it's $12,400.
What is it for single folks?
It's $6,200.
Okay.
And so, that's quite a bit of contributions.
Yeah.
And sales tax deduction. So normally, what we've experienced, those particular clients do not go over the standard deduction.
Okay.
Typically, unless they have a mortgage.
Yeah. So the standard deduction, is that going up?
It did go up slightly. It normally goes up slightly with inflation.
Okay.
So same thing with the personal exemptions will typically go up slightly with inflation.
So are itemized deductions going to continue to be something that we can see in the future, or are they going to start phasing those out?
Well, they started phasing out itemized deductions again in 2013, and they're also phasing them out in 2014. And it's based on your adjusted gross income. So the phase out for a single taxpayer starts when your adjusted gross income is $254,200. And for married filing jointly and surviving spouses, it starts at $305,050.
Okay.
So what that means is once you hit those levels of adjusted gross income, they start taking itemized deductions away from you on a percentage basis.
So, Gary, let me ask you this. This is the time of the year, or maybe even a few weeks ago, you guys, people have started, our listeners have started getting those packets from their accountant where they ask all these questions. Did you get married? Did you get divorced? Did you buy a house? Did you buy a property, an investment property? Did you sell an investment property? They ask you all these questions. A lot of them have to do with real estate. Why is the accountant gathering that information?
Well, that information basically is a rifle shot approach instead of a shotgun approach. So all your information can be collated and put in one central place.
Okay.
And it makes it a lot easier and more cost-effective for the CPA, first of all, to look at your information and see if something may be missing. And number two, it's going to reduce your fees typically because the CPA is not going to have to look in 2 or 3 different areas, looking at your source documents, your handwritten sheets, and then your organizer.
Okay.
The organizer is just a very good place, too, to organize your own thoughts.
Yeah.
Because normally it has last year's deduction amounts in it, so you have a benchmark when you start preparing that document.
Okay. So any advantages to from year to year selling and buying these investment properties? Are there advantages, or it's just the advantage that you have when you purchase such a property? Are there any tax advantages to it?
Well, I can give an example of the building I'm in. It's owner-occupied. I purchased it 5 years ago in a very good area and the height, and it's tripled in value. And I am paying, my mortgage is less than what I would be paying in rent if I were leasing in a commercial building.
Yeah, you got a great facility down there.
So, and also investment property, you get to take the property tax deduction. There is some limitations on investment interest, but you got to look over the last 5 years at the appreciation of real estate and raw land in the Houston area.
Yeah.
It's significant.
Real quickly, because I know we're going to have to go to break soon. Tell me about retirement plans. Any changes on those retirement plans, like your 401ks?
Well, the 401k edged up a little bit. So for this year, 401k plan has gone to $18,000, and with I want to set the $6,000 catch up. No, that's 2015. It's gone to $18,000 with the $6,000 catch up. For 14, it was $17,500 with the $5,500 catch up. Catch up is anybody over 50 years old.
Okay. Okay.
And I would highly recommend, if you qualify for a 401k plan, start it as soon as possible.
Yeah. All right. Well, very good. We appreciate it. Lots of great information from you. We have a lot of people who have rental properties. So let's real quick talk about rental properties. When you're buying rental properties, I always tell people to put them in an LLC. Don't buy them in your personal name. Put them in an LLC where it gives you a little bit of protection there. Would you agree with that? As for tax purposes, is it better to put them in an LLC rather than buying them personally?
Well, I like it in an LLC. First of all, the insulation for risk. Secondly, I like LLC partnership and or an LLC S corporation, probably the partnership for real estate. And the purpose behind that is all the information, the deductions, the revenue, goes on a Form 1065. And then for reporting purposes on your personal taxes, you will receive a K-1, which is a reporting document in which it will create one line item on your 1040, which is your personal tax return.
Okay.
Why is that good? Well, if everything is on the 1040, which is your personal tax return, all the rent income, all the deductions, and let's say you're a proprietorship and you got a Schedule C, well, your entire life is in that one package.
Yeah.
And I believe it makes you more auditable by the Internal Revenue Service.
All right. Well, I definitely think it's better to put those rental properties in an LLC. I know you have. I know you've talked to me before about the series LLC, where you can put a series of rental properties and they're all in one LLC. So I think that's a good thing for.
You just got to keep them in a separate series. You still have to keep them apart and isolated from one another. Have separate checking accounts.
Yeah.
But the advantage is you just have one entity to file a tax return for. And you can have everything in one entity instead of multiple entities.
All right, Gary. Well, I know you are very busy this tax season. Gary Cooper with Gary Cooper CPA down in the Heights. Give him a call. Gary, how can people find you if they want to give you a call to get some help this season?
Well, a couple of ways. CooperCPAGroup.com. You can find us on the internet. And our phone number is 713-243-8590. And by the way, we do return phone calls. So.
I love that about you, Gary. All right. Thanks. I appreciate you calling in.
Thank you, Shannon.
All right. We'll be right back here on Houston Real Estate Radio.